A free way to support the channel is by clicking the like button. It's help with the YouTube algorithm. Thank you so much. Here is a series of best value stocks for 2021. NortonLifeLock. NortonLifeLock engages in the provision of security, storage, and systems management solutions. NortonLifeLock have a dividend of 2.43%, which is 50 cents annually. Bulls say bundling Norton and LifeLock together could increase incremental revenue from consumers wanting a single management tool for antivirus and identity protection. Headline-grabbing breaches should continue to aid demand. Shareholder returns should be a focus for NortonLifeLock as the company does not have to deploy excess cash toward acquiring, developing, and marketing the latest trend in enterprise security. A new management team, without internal distractions like accounting issues, could steer NortonLifeLock toward profitable and sustainable growth. Bears say pricing in consumer security should continue to be challenging. The firm must contend with free alternatives to Norton while LifeLock has to win against the credit agencies and others. Leadership at Symantec, the predecessor to NortonLifeLock, has been a revolving door over the past decade, and inconsistent strategy may hamper execution. Data privacy legislation should cause enterprises to ramp up protection efforts, which could create fewer personal information breaches. Also, consumers may favor relying on their financial institutions and the credit bureaus to alleviate data losses. Analyst ratings. Buy, 38%. Hold, 50%. Sell, 13%. Get your free stocks. Stocks up to $1,400 with Webull and Robinhood. By signing up. Links in the description. NRG Energy. NRG Energy engages in the production, sale, and distribution of energy and energy services. NRG Energy have a dividend of 3.59%, which is $1.2 annually. Bulls say NRG's match between its wholesale generation earnings and its retail supply earnings across its asset footprint provides a hedge that stabilizes consolidated earnings. NRG's transformation has cut the business in half while improving credit metrics and generating substantial excess cash that it can return to shareholders and use for acquisition like Direct Energy. NRG's primary operations are in Texas, which we think will have among the fastest electricity demand growth of any state during the next decade. Bears say federal and state environmental regulations and renewable energy goals could erode profitability at NRG, fossil fuel power plants. NRG has been through several transformation plans during the past decade and now must integrate Direct Energy, making it difficult for investors to assess management's ability to make good long-term decisions. Power and gas prices in the eastern U.S. are likely to remain flat for at least the next 3 years as cheap shale gas and new build generation flood the region with energy. Analyst ratings. Buy, 80%. Hold, 20%. Sell, 0%. AGCO. AGCO engages in the manufacture and distribution of agricultural equipment and related replacement parts. Bulls say AGCO's diversified product lines, including grain storage and protein production, help minimize cyclicality experienced by its competitors. AGCO's international exposure positions it to capture growth opportunities in emerging economies. Revenue synergies between AGCO's mobile agricultural equipment and stationary products will expand margins and provide unique advantages over rivals. Bears say managing 4 tractor brands will perpetually put AGCO at an operating cost disadvantage to rivals with 1 or 2 brands. AGCO's revenue is largely generated in the EU 28, which is likely to experience declines in real farm incomes over the next decade. Intense competition from Mahindra and Kubota will negatively impact margins. Analyst ratings. Buy, 37%. Hold, 58%. Sell, 5%. Rockwell Automation. Rockwell Automation engages in the provision of industrial automation and information services. BELLOW. Newer initiatives like digital twin and augmented reality, as well as software subscription services that deliver predictive analytics should drive higher growth compared with historical results. Rockwell is the only automation competitor that integrates discrete, process, and hybrid manufacturing in a single, easy-to-use platform. Less than 20% factories are connected, and most insights that drive greater throughput and efficiency are now made at the edge, or closer to the manufacturing floor. Bears say. Rockwell's partnerships mean that it's sacrificing upside in both process and in the cloud as it's splitting the pie with Schlumberger and PTC. Rockwell has an insufficient breadth of product offering in the industrial Internet of Things race due to underinvesting in capital expenditures for the sake of protecting profitability. Rockwell's stock is priced for perfection, and it's still a cyclical business that's heavily driven by industrial production. Analyst ratings. Buy, 33%. Hold, 42%. Sell, 25%. As always, be sure to let me know your thoughts down in the comments. Be sure to smash that like button. Thank you so much for tuning in, and I will catch you in the next video.